All right, so next one, for the learning outcome at the end of this lecture, you should be able, all right, okay, it is expected that you should be able to explain the importance of accounting ratio, how they are used, identify the 5 category of ratio. We are going to learn 5 category of ratio, explain the purpose and function of each type of the ratio. Okay, and then interpret the ratio using examples, list and explain other long-term solvency ratio, and explain and interpret the trend analysis. Okay, so why we need the ratio? All right, you have learned to prepare the financial statement. So in the financial statement, you have learned the income statement and balance sheet. So we can see the profit or loss of the company in the income statement, and we can see how much is the asset of the company, how much is the equity, and how much is the liability. But how can you ensure that this much of asset is better than that much of asset of that company? Okay, so to know whether your company is doing better or the other company is doing better, it is through the financial ratio. Because, for example, your asset, okay, if your asset is more than company A's asset, doesn't mean that your company is doing better. Okay, so you can see later what do I mean by, if your asset is a lot, doesn't mean it is better than the other company. Okay, because through the ratio calculation and analysis, later we can see more profit doesn't mean that your company is doing better than the other company, because it can indicate a lot of things. Okay, so ratio analysis remove some of the mistakes surrounding the financial statements and pinpoint the area that need further investigation. All right, so from ratio analysis, we will know which company is doing better in which area. Okay, so it will be useful to satisfy the needs of the users. Okay, so why we evaluate the financial statement? Like, for example, we can see here, okay, this is the example of a financial statement. We have the net sales, we have the gross profit, we have the net income. So like I said just now, from the net sales, okay, so you can see here the net sales 156 and then net income is 41. So how can you know whether you are doing good with 41,000 of net income from this much of net sales? So we want to know, all right, is it 41,000 of net income from 156,000 of sales is good or not? So that's why we evaluate the financial statement. Okay, so we evaluate the financial statement to determine the financial performance and financial position of the company. So we need the annual report. So basically the annual report is needed because we want the financial statement only. We want the income statement, we want the balance sheet of the company. Okay, so basically those are the financial information that we want to analyze. If you want to analyze the non-financial information also, you can refer to the annual report, because in the annual report you have a lot of other than the financial statements. You have the director's statements, you have the audit report, you have background of the companies. So if you need other non-financial information, you still can get from the annual report. But okay, learning the ratio, we need the annual report most importantly because we want to get the income statement and balance sheet, so to be able to calculate all of the ratios that we need. Okay, so for example, okay, this is like very brief example of why financial ratio is important. Okay, so let's say you have company A and company B that you want to compare, and then if I give you only the net profit figure, okay, so company A, you have net profit figure of 200,000. Company B, you have net profit figure of 1 million. Okay, so if you just look at the net profit figure, you might want to say that company B is doing better. Okay, because looking at the net profit, okay, you will straight away jump to the conclusion that company B is doing better just because the net profit is bigger. But then it is not the case when you calculate the ratio. So in this case, we show you the ratio of the return on asset. Okay, so this is the ratio of return on asset. So return on asset basically means how much return you can get from this much of investment in asset. Because you, when you start your business, you have the capital, you have the money, you're going to use that money to buy the asset, okay, particularly the non-current asset, and you will use that non-current asset to help you to operate your business. So with that much investment of non-current asset, okay, how much you can generate the profit. If you spend 10 ringgit to buy the asset and you can generate more than that, okay, you can generate more profit, it means that you are using your non-current asset efficiently. But if you spend 1 million of money to buy the non-current asset, but you can only generate very small amount of profit, it means you are not using your asset efficiently to help you to generate the net profit. So in this case, if you want to calculate the return on asset, you are going to have the net asset information. So for company A, the net asset used is 500,000 to generate 200,000 net profit. For company B, net asset used is 10 million to generate 1 million of net profit. So if you just look at the figure in RM, it is really hard to tell. Okay, but then if you calculate in ratio, then you can see which one is better. Okay, so this is the return on asset. So we get return on asset of 40% of company A. So how to read this 40%? So this 40% is basically indicate that from every 1 ringgit of money that you invested to buy your asset, okay, you can generate 40 cents of profit. Okay, so you invest only 1 ringgit. Okay, we will interpret in very small number so that you can see. That's why we need the ratio. So for every 1 ringgit that you invested in asset, you get 40 cents of net profit. But for company B, for 1 ringgit invested in asset, you get only 10 cents of net profit. Okay, so here we can see that company A is doing better. Okay, so even though the company A, the profit generated is only 200,000. Okay, but then, okay, in ratio analysis, we can see that company A is actually doing better, even though company A did not generate much profit as compared to company B. Okay, so this is why the financial ratio analysis is important. Looking at the number itself, it's not sufficient for you to tell that the company is good. So you need the financial ratio analysis. You need to calculate the ratio analysis in order for you to tell whether the company is doing good or not. Okay, so of course in our story here, okay, in this slide, company A is doing better because you only spend 1 ringgit. We cannot say you only spend 1 ringgit, but for every 1 ringgit that you spend to buy your asset, you can generate 40 cents. But company B, for every 1 ringgit, you can only generate 10 cents. So here we can say that company A is doing better in terms of investment in asset and doing better in terms of using the asset to help them to generate the net profit. Okay, so that's basically what the financial ratio is. Okay, so like I said, financial ratio analysis, okay, we use because the figure in the financial statement is not enough to tell us that the company is doing good or not as compared to the other company and also as compared to the previous year. Okay, so we use financial ratio analysis not only to compare between the companies within the same industry. Okay, like for example, you want to invest in that industry and you get 1 to 10 companies within the same industry and you compare within 10 companies and you want to like decide which company is doing better. Okay, it's not just in terms of that, but we use financial ratio analysis to also analyze our own performance in our company within throughout the years. Like for example, you want to see whether you are doing better as compared to the previous year or previous 10 years. We also use the financial ratio analysis. Okay, so here we highlight because we just want to tell you that if you look at the financial year 2012, you have 41,000 of net income. Financial year 2011, 25,000. But can you tell that 2012 is better than 2011? Can you tell that 2011 is better than 2010? Okay, now from here, we actually cannot tell. Okay, because very high number doesn't mean it's good. All right, so you have to calculate the financial ratio analysis so that you will know which one is really good actually. Okay, so next one. We have 5 types of ratio: profitability, liquidity, efficiency, shareholder, and capital structure. So we have the users of this ratio. Okay, so the users of these ratios are shareholders. For profitability, shareholders might want to see the profitability of the company, how much profit the company generate, because shareholders expect they will receive dividend from what they have already invested in our company. So they want to see the profitability, whether the company is profitable or not, to declare the dividend to them. Okay, so they want to analyze, should they invest in this company or should they stop to invest in the company? Okay, so that's the shareholders. Management also, we want to look at the profitability, employees, creditors, investors, and competitors. Okay, so the profitability is very important because, for example, employees will want to know whether it is safe for them to stay working in that company or should they move to another company. Okay, so for the creditors, they want to see whether the company is able to generate the profit to cover up any interest on the credit or not. Okay, so for investors, it is the same as the shareholders, and competitors, of course, they want to see how their competitors is doing. Okay, so that they can develop new strategies to like to be maybe number one in the market. Okay, so next, the liquidity. So liquidity is talking about the ability of the company to meet the short-term obligation. Okay, so short-term obligation is current liability lah. Okay, so shareholders will be interested because in case of the company has to go under liquidation, it's the shareholders that will cover up all the credit. So it is very important for the shareholders to know about the liquidity of the company, about the ability of the company to pay back the short-term obligation. All right. For suppliers, they want to know about liquidity. So like I said, liquidity is about the ability of the company to pay back the short-term obligation. So if I mention short-term obligation, I am talking about for example, the things that you have under current liability. Okay, so the things that you have under current liability, of course, your creditor, right? Your creditor or the creditor lah mostly. Okay, so those that you purchase the goods on credit, your creditor. So suppliers want to know whether you are able to pay back the credit amount or not when you purchase the goods from them. Okay, so they want to decide, is it okay if they give you to buy on credit? Is it not okay? Okay, so it is the same as to creditors. Okay, so competitors also want to look at the liquidity ratio. They want to see whether you are able to pay back your credit or not. Maybe because they want to approach your suppliers. Okay, who knows, right? And then efficiency is talking about the ability to pay back the not ability, how many days you take to pay back your liability, the current liability, and also how many days you take to collect back your receivable. So shareholders, customers, and competitors will want to look at efficiency. And we have shareholders ratio. Okay, shareholders and investors will be interested to look at the shareholders ratio. So under shareholders, we have dividend yield and whatsoever. And then capital structure. This one, shareholders, lenders, and creditors and investors also will be interested to look at these things. Okay, so we will go through all of these. Okay, and we will relate why they are interested to look at on this ratio. Okay, so we have all of this explanation. Okay, so mostly I have covered just now. So creditors and suppliers, they want to look at your financial ratio because they want to look at the ability of you to repay back the credit amount. Okay, so when you purchase on credit, of course, your suppliers would want to know whether you are able to pay back the money or not. Okay, so for the shareholders, they want to look at how much dividend that you can pay, okay, and how much dividend that you have paid in the previous years, how much the profit that you can generate to pay back the dividend. Okay, that's what the shareholders want to see. Okay, so we have the financial statement analysis method. Okay, it means we use the financial statement. Okay, that's what it means by this one. Okay, so we need the financial statement data. Okay, we will use the mathematical relationship. It's very easy to calculate. Okay, and then we will present our ratio in terms of percentage ratio or proportion. Okay, so we will look at later. Okay, so these are the 5 financial ratio that I have already covered just now. So we will go to the first one, profitability. So we have 6 ratio under profitability. Gross profit margin, operating profit margin, net profit, return on asset, return on equity, and return on capital employed. Okay, so for profitability, basically, we want to measure the overall effectiveness of entities' operating management. We want to see how much they generate the operating profit. Okay, so looking at how much you generate the operating profit means also looking at how efficient you are in managing your expenses. Okay, you have to be able to imagine your income statement when I talk about this one. Okay, because operating profit means the profit that you get after you minus all of the operating expenses. Okay, if you get high sales but you get low operating profit means you are not okay or you are not efficient in managing your expenses. Okay, because if your gross profit is high and then your operating profit is low, it means your expenses between the gross profit and operating profit, you have all the expenses. Okay, if you have high gross profit and low operating profit, it means your expenses is very high and it means you are not efficient in managing your operating profit. Okay, and also we want to look at the entity's ability to earn profits, okay, in terms of gross profit, operating profit, and net profit margin. And then we want to see whether the profit affects the entity's ability to obtain debt and equity financing or not. Okay, so we will go to one by one. So first one, the gross profit margin. This one we want to see how effective is the firm to generate the gross profit. Okay, so after you have already taken care of all of the goods sold. Okay, so how effective is the firm at generating revenue in excess of its cost of goods sold? We are talking about gross profit. Okay, so I hope you still remember how to get gross profit. So gross profit we get from the sales minus cost of goods sold. So it means from sales, how effective we are in managing the cost of goods sold is how we determine whether we are good or not in generating the gross profit. So how to calculate the gross profit margin? We will take the gross profit and divide by sales. So in this case, you will need the income statement in order for you to be able to calculate this one. Okay, so operating profit margin. So we want to see how effective is the firm managing the production cost. Okay, this is what I have already explained just now. So you need the operating profit divided by sales. Also, this one you need the income statement and net profit. We want to see how much net profit is being generated from $1 of sales. Also, here we want to see how effective the company is in generating their total cost. Okay, so why I mentioned total cost? Because from sales until net profit, you will minus all of other costs, right? All of the expenses, like the expenses you have electricity, salary, okay, rental. Okay, so you will have to minus all of that before you get the net profit. So when we talk about net profit margin, we are also talking about how effective you are in managing your total cost before you get the net profit. So we will look at the example. For the gross profit margin, we need the gross profit. So here we have gross profit 575 divided by sales. So 1450, you get 39.7%. So remember, the gross profit margin is presented in percentage. Don't ask me why it is in percentage. Okay, this is the format. So you have to present in percentage. So operating profit margin, you need the operating profit. So remember, your operating profit is the profit before you minus any interest and tax. Okay, so if you look at, if in your expenses you already have interest, you need to add back the interest to get the operating profit. Okay, so operating profit 330 you have here in this example, divide by sales, so you get 22.8%. and net profit margin, you will take the net profit. Okay, so remember, you will have to take the net profit after tax. Okay, so whatever later also, okay, when we discuss about this ratio, whenever you look at the formula that have the net profit, please remember you have to take the net profit after tax. Okay, because later when you find the financial statement of the company, okay, company will have to pay tax, right? So tax will appear in their income statement. So you will have net profit before and after tax. So please take the net profit after tax. So you will have to take net profit after tax divided by sales. So you get 11.2. So how do we rate this thing? How do we know whether this thing are good or bad? Okay, so this is how we interpret all of this ratio. All right, so for gross profit margin, 39.7% means the company is able to generate 39.7 cents of gross profit from every 1 ringgit of sales. Okay, so how to tell whether this one is good or bad? So to tell whether this one is good or bad, you need a comparison lah. Okay, if you are standing alone, you don't know whether you are good or bad. Okay, you will know whether you are good or bad when you are standing with another person. Okay, when you are standing with another person, then you can see you are taller than him, or you are shorter than him, or that's when you can see whether you are good or bad. So in this case, if you have 2 companies, or if you have 2 years of performance, and if another company, let's say your company is 39.7 and another company is 40%, so it means that company is doing better. Okay, so let's say company B. Okay, so if company B's gross profit is 40%, it means that company is doing better. You only can generate 39.7 from 1 ringgit of sales, but the other company can generate 40 cents from every 1 ringgit of sales, even though it's not really very huge difference. Okay, but still this company B, is doing better. Okay, so for the operating profit, margin, okay, 22.8% indicates that the company is able to generate 22.8 cents of operating profit from every 1 ringgit of sales. For this one also, the higher the better. If you have another company that gets higher operating profit margin than you, then that company is doing better. Okay, so net profit margin 11.2% indicates that the company is able to generate 11.2 cents of net profit from every 1 ringgit of sales. Okay, so it means if you have another company that have higher net profit margin, it means that company is doing better than you. Okay, so for this 3 ratio, the higher the better. Okay. So Okay, another thing I want to highlight is, okay, we compare between companies, but we also compare in our own company. Let's say our gross profit margin here is 39.7%. Okay, so and then our net profit margin is here 11.2. Okay, but if I put 5%, okay, it means it is huge gap from gross profit to net profit. All right, so huge gap means you have to imagine your income statement. Okay, imagine your income statement now. From gross profit to net profit, you have expenses in between. If your gross profit margin you can get higher, but your net profit margin you can get lower, it means that in this case, this company is not really good. It's not good in managing their expenses. It means from the gross profit, they minus a lot of expenses before they can get the net profit. In this case, we can say that the net profit figure is very, very small, so that's why you get 5%. Okay, this is my example lah, 5%. Don't ask me where I get this one. This is my example. Okay, so here we can also tell you a story about this one. Okay, so next ratio for profitability, we have return on asset. Okay, so how to get the return on asset? We need the net profit. So like I said, for every ratio that have net profit, we need the net profit after tax. Okay. Okay, for return on asset, okay, we have discussed about this one earlier. Okay, the basic discussion just now. Brief discussion. So return on asset, we want to measure how efficient the company use their asset to generate profit. Okay, so like I said, we need half of our asset. Okay, no matter it's current asset or non-current asset. So how good or how efficient the company is in using their asset to generate the profit. That's what we want to see from return on asset. For return on equity, okay, our formula is net profit after tax as well, divided by total equity. So here we want to see how efficient the company use their equity, okay, to generate profit. So in this case, under equity, okay, imagine your balance sheet now. So under equity, we have capital, we have net profit, right? So we use capital to finance our business, and we use the net profit. We roll our net profit back, okay, rolling the net profit to operate our business. So here we want to see how efficient we are in using our capital, okay, and using our profit that we roll every year to generate the profit that year. Okay, so that's what we want to see in the return on equity. So for this thing, you need the income statement because you need the net profit after tax, and you need the balance sheet because you need the total asset and total equity. And lastly, under profitability, we have return on capital employed. So how efficient a company can generate profit from its capital employed. Okay, so the difference between ROE and ROCE is, for ROE, we use total equity. So under total equity, we have a lot of things, not only capital, but we have the net profit or the return profit, like I said just now. But under the return on capital employed, okay, we will use the capital figure only, okay, and we use the operating profit. Okay, so here, okay, so it's better that I change this one. How efficient a company can generate the operating profit from its capital. Okay, so this is our example. We have total asset, total equity, profit after tax, and we have long-term debt, and we have the profit before interest and tax. Okay, so profit before interest and tax is our operating profit. Okay, so for the ROA, return on asset, we will get the profit after tax 162 divided by total asset, we get 6.4. It is presented in percentage as well. For the ROE, we have profit after tax. We need to divide with your total equity 1007, so we get 9.5, also presented in percentage. For return on capital employed, we have the operating profit, which is your profit before interest and tax. Sorry. And then we need to, okay, add the long-term debt and total equity. Okay, so under this equity, you have the shares. Okay, so that's your capital employed, where you get the capital from. So for the company, we get the capital from the issue of shares, and also we get the capital from the long-term debt. Okay, so that's two ways of the company to get the financing to start the business. They can issue the shares. When they issue the shares, they get the money. So that's the money they use to start the business. And they can also issue the debenture, okay, or they can get the long-term debt to get the money to finance the business. Okay, that's also one of the ways to raise the capital. So here we get 11.9%, also presented in percentage. Okay, let's see how we interpret this. So for return on asset, we get 6.4. From every 1 ringgit invested in asset, the company is able to generate 6.4 cents of net profit. Okay, for this one, it means the higher also, the better. It also means that the higher the better. If you have another company that can generate 8 cents from 1 ringgit, then that company is better. For ROE, from every 1 ringgit invested in equity, the company is able to generate 9.5 cents of net profit. Also, the higher the better. And for ROCE, from every 1 ringgit invested in capital employed, the company is able to generate 11.9 cents of profit. Here, okay, to be more accurate, we put operating profit lah, because in our formula we use operating profit. Okay, so this is basically what you need to do in your presentation. Okay, so in your presentation you will need to explain the ratio that you use. So for example, you want to use ROA, so you will need to explain what is ROA, and then apply ROA to the companies. Apply means calculate the ratio, in this case 6.4 or 9.5. okay, calculate the ratio. And then lastly, interpret what is 6.4, what is 9.4. okay, put the interpretation in your slide, and also during your presentation you have to explain the interpretation. As go to the liquidity ratio. Okay, so liquidity means we want to see the ability of the company to meet the short-term obligation. Okay, so short-term obligation has to be highlighted because we are just talking about the short-term liability. So when I talk about short-term liability, straight away imagine your current liability. So when you want to calculate this ratio, just focus on the current liability. Okay, so we have the ratio, which is current ratio, quick ratio. Here, okay, so for the current ratio, we will use current asset divided by current liability. So you need your balance sheet to find out this figure. For quick ratio, okay, we will use current asset minus inventory. Okay, so quick ratio, also we call it liquid ratio or acid test ratio. Okay, we will use liquid asset only. Okay, so liquid asset is, okay, liquid asset is, imagine your current asset. Under current asset, you will have cash, bank, prepaid expenses, you will have inventory, you will have account receivable. Okay, so of all of those things, inventory is not liquid. Okay, not liquid means it is not, it cannot be converted into cash very quickly. Okay, in case you have to go under bankruptcy. All right, so for example, you have cash, bank, those are your money. Okay, no problem, it's already liquid. You have account receivable. Okay, you can ask people to pay back the money to you. You have inventory. You cannot ask people to buy your inventory. Okay, so it is considered as less liquid asset. So for the quick ratio, okay, we will take the current asset. We will take out the inventory because inventory is not really a liquid. So divide by current liability. So in our example here, we have the current asset, inventories, and current liability. So to calculate the current ratio, we take the current asset divided by current liability. You have 5.35 times. So this ratio is presented in times like this. And like I said just now, don't ask me why it is times, not percentage. This is the format. Okay. So for quick ratio, you have to take the current asset minus the inventories divided by current liability. Okay, next we will look at how should we read this ratio. Okay, so for the current ratio, we get 5.35 times just now. Okay, so it means the current asset of the company is 5.35 times more than its current liability. Okay, but if you interpret like this, maybe it is not really clear yet. Okay, so interpret in another way. So the company has 5.35 cent of current asset to cover every 1 ringgit of its current liability in case of anything happen. Okay, so it means it's good lah. Okay, your current liability is 1 ringgit only, but your current asset is 5 ringgit. So you are able to cover your current liability in case of liquidation. Okay, in case of bankruptcy or anything. Alright, so for the current ratio, the ratio of 2 to 1 is already okay. 2 to 1 means if you have 2 ringgit of current asset for every 1 ringgit of current liability, it should be enough for you to cover the current liability. Okay, for quick ratio, you have 2.63 times. So it means liquid asset of the company is 2.63 times more than its current liability. Or, okay, to make it better, you can also interpret like this. The company has 2 ringgit and 63 cents of liquid asset to cover every 1 ringgit of current liability. So it means it's still good. Okay, because if your liquid asset or current asset is more than your current liability, it means you are already safe. Okay, if anything happen, you are safe to cover all of your current liability. Okay, so for this ratio, these two ratio, the ratio of 2 to 1 is already safe for you. But of course, the higher the better. If you are talking about comparing company A and company B, okay, the higher would be the better. Okay, so next ratio we have efficiency ratio. So under efficiency ratio, we have inventory turnover. So inventory turnover measures the number of times on average the inventory is sold during a period. Okay, so we want to see here, okay, how many times the company reorder their inventory, or it means how many times the company sell their inventories. Okay, the higher the better. It means if the higher means the company is selling their inventory faster than the other company. Okay, so to calculate this one, you have cost of sales divided by inventory on average. Average means you will have to take the closing inventory, closing stock plus opening stock divided by 2. That's the average inventory. Okay, in case you don't have the one of this information, usually you don't have opening stock information, we will take the closing stock information only. Okay, but if you have both information available, please use closing plus opening divided by 2. Okay, and also under efficiency ratio, we have account receivable days. So this one is to measure the duration of an entity to collect its credit sales from client. Okay, credit sales means we are talking about account receivable. When you sold the goods on credit, that's why you have account receivable. Okay, that's why you have debtors. If you sold the goods on cash, you will not have debtors. Okay, so this ratio, we want to measure how quick you are in collecting back the money after you sold the goods on credit to your customer, or how quick you are in collecting the money from your debtors. Okay, for this one, the quicker the better lah. Okay, so your formula is account receivables on average. Means you will have to take the opening account receivable and closing as well. Okay, so it means opening is what you have from the last year. Okay, the closing last year will be opening this year, and the closing this year will be closing this year lah. Okay, so divide by sales, total sales, and times with 365. But then similar to inventory just now, if you don't have opening figure for account receivable, just take the closing figure. Okay, no problem. Okay, because we by right for the these things we use the estimation. It means it doesn't need to be accurate, but it needs to have the figure that you get from the balance sheet, not the one that you assume yourself. Okay, so next one, account payable days. We want to measure the duration of the entity to repay its creditors. For this one, we want to see also how quick the company is in paying their creditors. Okay, so the faster the better lah. Okay, it is good news to the suppliers and creditors. Okay, they want the company that pay faster cash to them. Okay, so your formula is account payables on average as well, divide by purchases or cost of sales times with 365. You can use either purchases or cost of sales depending on which information that you have. Okay, but then do not be surprised if both figure will not give you the same answer. It will never give you the same answer because our purchases and cost of sales, cost of goods sold are different. Okay, but then like I said, we calculate the ratio, we use the assumption only. It means nothing will ever be accurate, but then you still need to take the amount from the financial statement, not the amount that you create yourself. Okay, so let's look at how to calculate this one. First, for the inventory turnover, we have inventory in our example 625. So let's say the inventory above is closing and opening inventory is 600. So you have to have closing plus opening divided by 2 to get the average inventory. So we take 875, the cost of sales, divide by average inventory, so we get 1.4 times. For account receivable days, we take the account receivable, divide by the sales, total sales, times with 365. Okay, this is your formula. 430 divided by 1432 first, then times 365, not 1450 times 365 and then 430 divided by this thing. Okay, and then okay, so for account payable days, where is it? Okay, account payable divided by your purchases, or you can divide with your cost of sales as well. It will give you more or less the same answer, but it's not going to be very same answer. Okay, so you get 47 days. Okay, so how do we read this ratio? So for inventory turnover, the company managed to sell their inventory 1.4 times during the year. Okay, so we are talking about the inventory in a very big warehouse lah, this thing. Okay, so 1.4 times. It's not, we are not talking about every day how many inventories that you sell. We are talking about once you order. Okay, so once you order your inventory, you are not going to order like very small number. You are going to order very large number. Okay, so for example, you order your order in 1 year is 3 times. Okay, so from 3 times order, how many times you can sell your inventory? So in this case, you are managed to sell your inventory 1.4 times during the year. So for this one, of course, the higher the better lah. Okay, so the higher the better means if you have another company that sells 2 times during the year, okay, it means they are selling their inventory faster. Okay, so selling the inventory faster means you are good in managing your marketing team, you are good in managing your advertising, you are good in managing your inventory as well. Okay, so next one, account receivable days. Okay, 109 days. So it means the company took 109 days to collect their account receivable. Okay, so 109 days, it means from the day you give the you sell the goods on credit. So let's say you sold the goods on 1st January 2021, okay, on credit to your customer. Okay, that's why you have account receivable. So 109 days later, okay, you are able to collect back the money. If you sell on 2nd January, then 109 days later on average. Okay, so on average, the company took 109 days to collect back their account receivable. Okay, so why this ratio is important? Okay, because we want to know how quick you are in not managing, in generating cash. Okay, so when you collect the account receivable faster, means you can generate the cash faster. Okay, you have cash faster. So for this one, okay, the lower the better. Okay, so it means if you have another company that can collect the account receivable in 90 days, okay, let's say another company can collect their account receivable in 90 days only. So it means that company is better lah. Okay, that company is generating cash faster than you. All right, so this one, the lower the better for this case. And then the account payables, okay, 47 days means the company took 47 days to pay their account payables. Okay, this one is a good news to any creditors or any of your suppliers. Okay, because suppliers want to look at want to see which company is good in paying back the credit. So for this one also, the faster the better. It means the lower the better. The lower days the better. Okay. Usually, it is depending on most of the company. The account payable days is depending on account receivable days, because if you can generate cash faster, it means you have available cash to pay back your account payables. Okay, so let's say, okay, in a company, if you want to see whether the company is using their cash efficiently or not, you can look at the account receivable days and account payable days. Like for example, account receivable days is 109 days. Okay, and then, okay, let me put here, account receivable days is 109 days. Okay, and account payable days 109 is a lot, right? We have 365 days only in a year. So this company is not good in collecting back the debtor. So let's say 60 days account receivable days, and then account payable days is, let's say, 150 days. Okay, this is my example only. So if you look at the account receivable days, I give you the example. You can collect your account receivable in 60 days. So it means you are making cash quick. Okay, but then you take a lot of days to pay back the account payables. So it means this one, you are not managing your cash very effectively, because it is believed that once you are able to generate cash, you should use your cash to pay back your account payables. Okay, so if you are quick in collecting the debts, but you are not quick in paying the debts, it means you are not very efficient in using your cash. Okay, so that's what we can relate account receivables and account payable with. So next one. Okay, so next we will look at the capital structure. Okay, so capital structure, we want to measure the entity's ability to pay interest and face value of debts when it's due. Okay, so capital structure is talking about long-term liability. Okay, so we have efficiency ratio, not efficiency, we have liquidity ratio just now, that we are talking about the ability of the company to pay back the short-term obligation. So capital structure is talking about the ability of the company to pay back the long-term obligation. And also under this ratio, we are also talking about the ability of the company to pay back the interest on long-term obligation. Of course, because when you have long-term obligation, it comes together with interest. Okay, so your long-term debt, your long-term loan must have interest. Okay, so here we want to look at your ability to pay back the long-term obligation, also your ability to pay the interest on long-term obligation. So under this one, we have debt ratio. Okay, so debt ratio, we want to look at the measure the proportion of the entity's asset financed with debt. Okay, so like I said just now, financing of the company, to finance the company, you have two methods. The first is from issuing of shares. The second is from getting the debts. Okay, so here for the debt ratio, we want to look at how much of the asset of your company is obtained using the long-term liability. Okay, so we have this formula, total liabilities divided by total asset. Okay, also next one, we have debt to equity ratio. So this one is to measure the proportion of debt relative to equity financing. Okay, so again, like I said, you have two methods to finance your business, either from equity and from liability. So here, this ratio, we want to see whether you finance your company using debt, whether you finance your company using more debt or more equity, because both will have different effect. If you finance your company using more debt, it is high risk because debts comes together with interest and the fixed obligation to pay back the principal amount. Fixed obligation means you cannot avoid. But then if you finance your company using the equity by issuing the shares, okay, the payment of dividend is not obligated. It means it is not fixed. When you make profit, you can pay. If you didn't make profit, if you make loss, then you don't have the obligation to declare the dividend. Okay, so I will put here. So difference between financing business using liabilities and equity. Okay, if liability, we know we have to pay, we cannot avoid. Okay, so we have payment of principal. Is it principal or PAL or PLE? Check that one yourself. Okay, you have the payment of principal and interest on loan. Okay, cannot avoid. Fixed. Okay, so this one doesn't matter you make money or you don't make money, you have to pay. Okay, so that's the financing by liability. So next, financing by equity, which is issuance of shares. So when you issue the shares, you have the obligation to pay the dividend to your shareholders, but that obligation is not fixed. Okay, so you can avoid lah. Okay, so I can say that you can avoid. Obligation is not fixed to pay the dividend. It will be depending much on whether you make profit or not. Okay, but for liability, you make profit or you don't make profit, you have cash or you don't have cash, you have to pay interest, you have to pay the principal amount when the time comes. But for equity, okay, if you don't have cash, if you don't make profit, you don't have the obligation to pay the equity. So that's, to pay the dividend. So that's why debt to equity ratio is very important, because the shareholders want to look at whether your company is safe or not. Okay, because at the end of the day, for this liability, if your company has to go under bankruptcy and your asset, the company's asset is not enough to pay back the liability, you as the shareholders are the one who will have to pay back the company's liability. Okay, so it is very important, this one. So we want to see whether the company financed their business using more equity or using more liabilities. Okay, and then next one, we have times interest earn ratio. So this one, we want to see the ability lah. Okay, ability and how much operating profit they generate to pay the interest expense. Okay. All right, so this one is in terms of calculation, how you calculate. For the debt ratio, we have total liabilities divided by total asset. So we have 33%. Okay, so debt to equity ratio, we have total liabilities divided by total equity. So we have 49%. So debt ratio and debt to equity is presented in percentage, times interest earned is presented in times. Again, don't ask me why. Okay, so times interest earned, we will get the operating income, okay, divided by interest expense. So we have 5.5 times. So how to interpret this ratio? So for the debt ratio, okay, so 33% means 33% of the total assets of the company is financed with debts. Okay, so 33% is financed with debt. It means the balance is financed with equity lah. Okay, so it's good lah, because it means the company doesn't use much liability to purchase their asset. Okay, and then debt to equity ratio. Okay, before that, debt ratio, it means the lower the better. Okay, so the lower the debt ratio, the better. Okay, so lower means the company use less debt to purchase their asset, to help them to operate the business. Okay, so for debt to equity ratio, okay, we get 49%. So the company has 49 cents of debt for every 1 ringgit of equity, or 49% of the financing of the company is from debt. Okay, so 49% of the so the balance is from the equity. So it means, okay. And then next one, sorry, wait a minute. Okay, so next one, for the times interest earned, 5.5 times means the company has 5 ringgit and 50 cents of operating income to cover every 1 ringgit of interest on loan. So this one is good lah. Okay, so for interest times interest earned, if you get the ratio of 1:1, it should be okay, but then it's not really good lah. Okay, because you still have to generate the net profit. So for times interest earned, the higher the better. Okay, but if it's more than 2, it should be okay. For debt to equity ratio, the lower the better. Okay, but okay, this is depending on what type of investor you are. Okay, so it is very depending on what type of investor you are. For the risk averse investor, the investor that doesn't want to face so much risk, they want to have the debt to equity ratio lower. It means they want to have a company that does not have much debt. Okay, but then for the investors that looking for high risk, high return, they might want to go to a company that have higher risk, means higher gearing ratio, higher debt to equity ratio. Okay, so that is depending on what type of investor you are. Okay, so next one, we have shareholder ratio. Okay, so indicate how well a company is performing in relation to, we want to look at the price of share and the payment of dividend to the shareholders. Okay, in related to the number of shares issued. So first, we will look at the dividend yield and the shareholder ratio. Dividend yield is to measure the real rate of return by comparing the dividend paid to the market price of share. So this one, we want to see from every 1 ringgit you pay to purchase the share of the company, how much dividend you can get. Okay, like if you pay 1 ringgit, of course, if if I am the investor of the company, if I pay 1 ringgit, I would want to get maybe 1.5 or 1 ringgit 50 cent of dividend. We want to get higher dividend than what we pay. Okay, or if we can get as much as we pay is already okay. Okay. B, earnings per share. It indicates how much of a company's profit can be attributed to each ordinary share of the company. Okay, so this one we want to see whether the company is profitable enough to distribute their profit to the shareholders. Okay, and C, price earning ratio, how much investors are willing to pay per dollar of earnings of the firm. So this one we want to see how much the investors are paying in relation to the earnings per share. Okay, so for example, earnings per share is only 1 ringgit, but how much investors willing to pay? Maybe 2 ringgit. Okay, so we will look at how to calculate. Okay, we already have the formula just now. So for the dividend yield, we will take the dividend 100 ringgit divided by number of ordinary shares. Okay, and then divide with market price. Okay, because for the dividend yield, okay, we want to have the dividend per share. So you need the dividend per share. So you have the total dividend here, 100 ringgit. Number of shares is 100. So that's why you have to take 100 ringgit divided by 100 units of share to get the dividend per share. Okay, so this one is dividend per share. And then divide with market price per share. So you have 5%. Okay, later we will look at how we read this 5%. So earnings per share, okay, we will take the net profit and then divide with number of shares. Okay, so we get 1 ringgit 62. And price earnings ratio, okay, we will take the what is your formula just now? Forgot already. Market price per share in earnings per share. Okay, so your market price is 20 ringgit. So divide by your earnings per share that you get here. So it's 12 times. Okay, so let's see how we read this one. So for dividend yield, you get 5%. So dividend paid by the company is 5% of the market price of the share. Or, okay, to make it better, for every 1 ringgit paid to purchase the share, the shareholders can get 5 cents of dividend. Okay, so this sound not better, but more clear, right? Okay, so if you purchase the share and you pay 1 ringgit for 1 unit of share, you can get 5 cents of dividend only. So you decide lah whether it's good or not. Okay, so for this one, of course, the higher the better. The company that can pay higher dividend means the better for the shareholders. Okay. So next one, earnings per share, 1 ringgit 62. The company can attribute 1 ringgit 62 of the net profit for every unit of share in the company. Okay, this one also, the higher, the better. Okay, so it is not really related to dividend yield. So because dividend is what we calculate with the real payment of dividend. Okay, but the earnings per share, we just calculate based on the profit. So if you get, we go back to this one. If you get 162 ringgit of net profit, doesn't mean that all of this you will pay to your shareholders, because you still need money, or you still need to have the rolling profit to continue your business to the next year. So the dividend yield, okay, you can see that it's not the same. Okay, because, okay, whatever that you attribute from your profit doesn't mean that's how much you pay as the dividend. Okay, but then we just measure because we want to see whether your company is doing good or not. So for this one, it means the higher the better also, because the higher means the company is better in generating the profit to be attributed to each of their shareholders. Okay, so to be attributed doesn't mean you will attribute all. Okay, so price earnings ratio, you get 12 times. So here, for every 1 ringgit earnings per share of the company, the investors are willing to pay or need to pay higher than that. Okay, 12 times higher than that. All right, so for this one, okay, you can see that the market price per share is 20. Or here, even though the investors know that the company is not making much profit or is not giving them much dividend, they are still willing to pay 12 times higher than the earnings per share. Okay, so here you have to understand, sometimes with speculation, the market price of share can spike up. Okay, so any speculation can increase the market price, and any speculation can make shareholders willing to pay higher to buy the shares of the company, because they are expecting that with speculation they will generate more profit, they will generate more sales to get more profit, and at the end of the day they can get higher dividend. So the price earnings ratio also doesn't really have any relationship with dividend yield or earnings per share, because your profit might be lower now, okay, from the calculation, but then when you check the market price, it is high. Okay, so market price can be high, not necessarily because of earnings per share and not necessarily because of dividend yield. Okay, it might be because of other non-financial information. Like I said just now, it might be because of speculation. Okay, so speculation can be when you change director, or when one of the directors died, it can affect the market price of the company. Okay, so speculation can make your market price to be higher, and people are willing to pay to buy your shares because of speculation. Okay, so here you will have to decide lah. Okay, so price earnings ratio, higher or lower is better. Okay, so if price earnings ratio higher, okay, it means people expect the company is going to be better in the future. That's why the market price spike up. Okay, but then it does not necessarily mean that it does not necessarily mean that you will get the same result as you expected in the future. Okay. All right, so that's all in terms of ratio, the types of ratio. Okay, what are the ratio that you have under all of the types of the ratio, how you calculate, and how you interpret. So basically, these are the things that you need to do lah, okay, in your presentation. Okay, so next I will cover on, okay, how you interpret or how you compare between two companies if you have to compare between two companies.